sanctuary if you're ready tonight. I know that it's all so heavy. Won't you let me inside? 'Cause I could be your sanctuary.
What's up guys, hope everyone is doing well. In this video, I'm going to be going over a number of things when it comes to market analysis, technical analysis, whether it is fiat or crypto. All generally applies pretty much the same. The first half I'm going to be going over just kind of touching at a face value a number of topics and ideas that have been applied to understanding market data and things along this nature. And then the second half I'm going to be going over explaining how I've developed my personal trading strategy, how I personally look at the market. But first off, here we can see that markets are traditionally broken down into bull, bear, and kangaroo markets. Bull, obviously, prices going up. Bear is prices going down. Kangaroo is prices going sideways within a specific range. It's bouncing from $5 to $10 for the last 2 months. It's in a kangaroo market. This should be pretty self-explanatory. Most people should already be aware of something like this, that they've at least been looking into technical analysis in general. Here are, I would say, 4 of the main trading strategies. I'll have a link in the description. I did find one website going over 16 different ones, but after reading it and looking at it, I came to the conclusion that you can pretty much collapse those 16 into these 4, and then the other 12 would basically essentially apply as kind of like sub aspects of these 4 main trading types. The other thing I wanted to add is that my personal strategy, I would say, is a type of position trading on the longer term of things, not necessarily limited to several weeks as it says on this image, but it could go out to years, even decades. Kind of factors into the idea of hodling, as it's called, or holding, DCAing into Bitcoin due to the technology that it does represent and how unprecedented and viable it is as an asset in order to earn money off of simply. Here, these are 3 different types of way the price is typically shown on a price chart. We see a candlestick to the left, bar chart in the middle, a line chart to the right. These are the 3, I would say, roughly main categories. And there's different types of candlestick charts like Heiken Ashi, TradingView, the website most commonly used for market analysis. Also has candles known as high and lows, and then a bunch of other candles as well, types of line charts as well. But these are roughly the 3 kind of the most often ways you'll see some sort of price data shown on a chart. Here starts the patterns. I'll say these are beginner patterns on this image. The classic head and shoulders, the inverse version of that, double tops, double bottoms, triple tops. See the cup and handle, rising wedge, falling wedge, horizontal channels within consolidation. Like I mentioned earlier, these are the most simple, I'd say, beginner types of patterns to understand and notice within an actual asset, whatever it may be. Here are a number of harmonic patterns: the bullish butterflies, Gartley's, a bullish sharp, bearish 3 drives, etc. These are, I would say, at an intermediate level. They come a little bit more complexity to them. Most commonly, they're used with some sort of Fibonacci extension with respect to each of the vertices or the pivot points of the patterns. Here are LA waves. Also, I would say this is on an intermediate level. It's kind of not too much different from really these first 2. For the most part, these Elliott waves are like these first 2, basically oscillations of M's and the W's, as I've gone over plenty of times in this content on this channel before. We can see impulse waves, zigzags, ABC patterns. Also within, we can see on here symmetric triangles, ascending triangles, a widening triangle. Then there's a number of rules, because this is wave analysis. It's typically what it is called. You'll see, as it has over here on the left side of this image, impulse waves, corrective waves, triangle waves, impulse waves, etc. Here is Wyckoff, logic or Wyckoff patterns. These, I personally haven't really looked too much into this. That hasn't really been drawn to it personally within my researches. But I would say this is more towards the advanced or harder to understand when it comes to applying some sort of pattern-based schematic to understanding and making sense of why price is doing what it is doing. These are candlestick patterns. I also don't personally use these, although what I do want to elaborate on is the bottom left where it says basics. You can see the demonstration of what a candle actually, if you're using a candlestick chart, you can see with the bearish, the red candles, it opens at the top of the body, closes at the bottom of the body, has a wick high and a wick low, and then the bearish candle is this reverse of that where it closes at the top of the body and opens at the bottom of the body, but the wick low and the wick high are also the same as the bearish candle. Here are a number of technical indicators to kind of take the data that is being shown on the price and put it in some sort of other representation in order to gain some other understanding about the momentum of price, the strength of the price, the acceleration or velocity of prices. I'll typically refer to it on this channel. Other than that, you see moving averages. The moving average convergence and divergence is what is known as a MACD. That's where the momentum comes from, Bollinger Bands, money flow index, etc. Here is an image detailing these. For example, on the top, uppermost box, you see the moving averages overlaid upon the price, the red and the blue lines. We see the RSI, stochastic RSI, and the MACD. I will typically explain these away as being, for example, RSI is a velocity of the price, stochastic RSI would be an acceleration of the price, and whereas the MACD, as I said already, is the momentum of the price. These can be thought of as derivatives of the price chart. I'll typically explain it. For example, if you've ever been in a physics class and you were trying to calculate the trajectory of an object, just the movement of an object about space over a period of time, take the first derivative of the object moving over time, gives you the velocity, take the derivative of that, acceleration, so on and so forth. Here is a list of types of divergences when it comes to technical indicators. These are typically used on RSIs and stochastics and MACDs. For the most part, it's really just RSIs, but I personally generally look for some sort of divergence on really any technical indicator when it comes to those three that I mentioned. There's different types where we can see bullish and bearish, obviously. Then we have weak, medium, and strong. Weak is typically just defined as basically there's not really much of an intensity to the angle of the divergence you're seeing. You can see it's flat, and the red angle at the weak bullish divergence is just not really prominent. Whereas you continue to go towards the strong, you can see that the angle of divergence, the intensity of it, is a lot more prominent than the weak. Those are typically reversals. The bullish and bearish divergences seen as reversal patterns. Continuations will typically be found with hidden bullish divergences or hidden bearish divergences. I've been going over a lot recently how Bitcoin is showing hidden bullish divergence after seeing bearish divergence. As an example, if you go back to the bull market from 2015 to 2017 for Bitcoin, when it hit 20,000, you would find that there was a number, I think it was 3 and then 2 hidden bullish divergences printed as the price continued to go up in an uptrend. A lot of times you'll see something that in an uptrend you'll see multiple bearish divergences printed, but if it's printing hidden bullish divergences, it is signaling at the continuation of that uptrend despite the bearish divergence being printed. Obviously, in any market, when it is an uptrend, it's not just going to literally go straight up unless you're looking at some higher time frame chart. At some point, there's going to have to be some sort of cool down. Things are going to overheat. It needs to relax a little bit in order to kind of refuel itself in order to continue to go higher in an efficient manner. So that really kind of wraps up the first half. As I said, now I'm going to get into my personal strategy. First off, I want to go over this chart. The way that I think about my strategy, as it says in the text box in the top left, look at it as just a sophisticated holding or hodling, as it's typically said. I prioritize long-term over short-term, which is why I mentioned about position trading earlier. I prioritize buy ranges over buy points. I also think the confluence in a many number of indicators is very important as well. And then when it comes to the emotional side of the market, I think having an understanding of uncertainty is highly important. And by that, what I mean is that you have no idea, anybody has no real idea what is going to happen. It doesn't matter how much confluence you're seeing, it doesn't matter how many people, how many things, whatever it is, how strong it may seem that something is going to head into a next massive bull run or even a bear run. At the end of the day, I think having this understanding of uncertainty, the fact that you, at the end of the day, don't have any idea what is actually going to happen. You have a bias and you think all of this data makes the most sense, but where I think this comes in as being important is keeping you grounded, of not being caught up in emotion while trading and becoming an emotional trader that makes rational decisions because they are becoming too identified and attached to some sort of emotion they're placing upon a specific set of data that leads them to thinking some massive bull run is coming, for example. Outside of that, the main thing that I want to go over on this chart is I've used the same indicators on this chart this channel rather, for any number of months. These are a list of the indicators that I use. If any of you would want to take a screenshot or use any of these, I think there's like 16, or no, there's 14 or 13 actually, that I will kind of cycle through. Typically, I will keep it staple as an RSI, a stock RSI, and a MACD, and then I'll add other things like Bollinger Bands, moving averages, but I really like to pay attention to those, that velocity, the acceleration, and the momentum, like I mentioned earlier, because I think that's pretty important. But another indicator that I use is this indicator called RSI bars. It basically puts RSI data into the price chart by color coding the candles. The pink ones and the turquoise ones are what is a part of that indicator. The pink ones denote when price is highly oversold. It starts to print pink vector candles. They're pink, or they're just vector candles in general because vectors show, give you data that gives a direction and also some sort of magnitude, some sort of value showing its strength in that direction. For example, 50 miles per hour going east. And then the blues, the turquoise, they represent when the bull market's basically beginning and it's oscillating within the the overbought range as it's continuing throughout a bull market. And we can see going all the way back to, this is the 6-day chart. There's a lot of confluences on this chart, which is why I'm going over this specific one and not like, why am I not using a weekly chart when it's just 6 days, may as well use a weekly. But there's a lot of interesting things on this 6-day chart. And another thing about my trading strategy is that I look at every single time frame. I will go all the way up to the 12 monthly and then I'll go all the way down to the hourly sometimes, like subsequently, and then come to a conclusion based upon every single actual time frame. But here we can see again, we get the pink vector candles printed. We bring up the RSI, we can see we're in our oversold territory down here. I'm going to leave that unshown for the most part. We then head up into this entire bull market right here. You can see that the RSI was within this upper range the entire time. So now that we reached $30 back in June of 2011, this ended the first cycle according to my phase cycle theory of Bitcoin. I'm not going to go over that in this video. I will have a card linked at the beginning of this video where I go over that more elaborately if you're interested or not already aware. But so we can see we ended our bull market. The turquoise vector stopped printing. We see the Ichimoku cloud, so this turquoise line and the pink line also flip shortly after. When we come down, we get these red and these green and the black candles. This is a part of the trader's reality indicator. This also gives you a bunch of estimated moving averages, a bunch of other things, but the estimated moving averages and the volume-based vector candles are really the main things that I use personally. And then this black band right here is the band that is associated with the 50 estimated moving average of the trader's reality indicator. You can see as soon as we lost it, we then began to print pink vector candles. This right here, obviously on top of this one, but I don't really feel like this one's worth mentioning. But anyways, this first little area right here that I've highlighted in yellow, as we lose this 50 EMA, is my first testament to me prioritizing buy ranges over buy points. As I said in my community tab post about this, I would say this strategy in general is at a middle point between trying to maximize profit and also trying just to be safe, and factoring in that understanding of uncertainty, like I said. I mean, the reason why I personally would kind of look at this in that kind of long position dollar cost averaging avenue is because once it crosses below this, I see this as a signal to just start slowly buying into Bitcoin over a period of time as it's going down to its lower lows. After you've done that, I mean, yeah, you're down, you know, for example, right here. If let's say I started buying right here, all the way down to low, my first number of investments will be down basically 66%. But due to the understanding of the strategy and what it is, what it had been basically done here, especially looking in hindsight, given how things have carried on out from here, going from $2 all the way up to $266, this was basically the best area or period of time to start setting a bunch of investments into this asset, as it soon afterwards made up for that losing 70% and continued to then go far higher than it had been. At some point, we will also see the Ichimoku cloud cross once more. We see it right here, shortly after we met this local high right here back in January 2012 at $7. We see, once we get the turquoise vectors to print, this coincided with getting back above the 50 EMA band. Do that leading up into this first peak right here, the first peak of the second half of phase 1 in my cycle theory. Come down for that retracement, come back up, start to print the pink or the turquoise vectors once more as we start to really kind of get back above these previous highs. See, we come back up here, turquoise vectors stop printing, Ichimoku cloud crosses once more, flip the 50 EMA band, we then get our pink vector candles. I personally would then see this as a signal to just to go ahead and start buying in. Again, because of the understanding of uncertainty, for all I know, something like this could have happened right here, and we would have then begun the next bull market like that, instead of, you know, continuing to actually go down and trade sideways like this for such a long period of time. That is also it's really the main point, let's say, in the understanding of uncertainty aspect, is because you don't know whether or not it was going to stop right here, if it was going to continue to go lower. So I think it's just, like I said, that midpoint between maximizing profit but also being safe about it, because you don't know if it actually is going to continue to go lower. Like, for example, I mean, if I go back to all of these prior times, you can see basically I had a double bottom right here of the pink vectors. Same thing right here. I could, you know, start to get to thinking about that and begin to believe, well, I just need to wait till the second drop. What if one time I'm wrong and I'm trying to wait towards the second drop and now I've missed my entire opportunity to buy in at this lowest range in the first place? Further on, we can see once we flip the EMA band again, we see Ichimoku cloud is also flipped leading into this. We start to print the blue vectors, beginning really kind of like that final line in the sand. Bull market's begun, head up to $20,000 end of 2017. Stop printing the pink, or my bad, the blue vector candles. We're heading back down. We flip the Ichimoku cloud as well, heading back down, lose the 50 EMA. Again, we see we print our pink vectors here. We have another buy range, an opportunity to start buying. Come back up for the intermediate high right here when we hit around 14,000. This is relative, or synonymous rather, to this intermediate high back here that I mentioned back in 2012, because those are both phase 1 of my cycle theory. March crash, we also saw one single pink vector printed. We lost right here the 50 EMA pretty drastically in a V-shaped recovery format. Quickly went down, quickly came back up, reclaimed it, started to print our blue vectors once more. We got the Ichimoku to cross, come back up. No more blue vectors. Ichimoku cloud crosses once more. We got this kind of relief rally right here. We didn't really lose the 50 EMA. We found support, had bullish divergences as well during this time period back in 2021. Went back up to hit 69,000, forming that double top. We also got a bearish divergence at that as well. We flipped the Ichimoku cloud. Shortly after that, we began to lose the EMA band. Then we flipped into printing pink vector candles. We have our final buy zone right here, as I've been going over. We have flipped the Ichimoku cloud right here back in January this year. We are seeing the price more towards the upper side, already obviously clearly broken out of the 50 EMA a little bit. The 50 EMA also is pretty tight right now, similar to how it was back here when we saw this major drop, which basically, in my opinion, given we've already seen a major bear market, printed our pink vectors, buy range has been seen, flipped the Ichimoku cloud. We've been in this, I would say, a bullish transition. Things are more likely to continue to go up from here. As I've been saying recently, for all intents and purposes, we could come down and test 20,000 as the I would say the last, the bottom of the bear bull market support. The final thing I want to mention here is, again, for those of you familiar with my analysis and my phase cycle theory, I believe ever since Bitcoin hit 15.4 thousand, it is relatively synonymous to when Bitcoin had its March crash. We've been seeing a very similar bullish buildup. If I go back, we can see we're basically seeing this kind of like just slow buildup, this kind of humping, almost like camel humps of price. We see our pink vectors printed, or my bad, we see the blue vectors printed right here. You could even say that we can see kind of one hump right here, two hump, three humps. We also, again, like I said, we got those blue vectors printed. If I go back to this, we can see kind of this one hump, two hump, three hump as well. Obviously, it's not exactly the same. Bitcoin is maturing and decaying over time, so the synonymous points in the phase cycle theory will look different over time because things are decaying. So it's obviously not going to look the exact same, but it's still in like an archetypal sense, the same thing happening in a cyclical fashion. But the most interesting thing about this is that, again, zooming back here, we got the Uchimuggi cloud across, we got these three humps, or two humps, however you want to look at it, I mentioned, we got the blue vectors, then we had this very short period of time right here is where basically in the last like 2 weeks of September, where we get this Ichimoku cloud across for a very brief period of time, about 2 days, or my bad, 2 bars, so 12 days, and then the bull market began. We go to where we are currently. Again, we see the same thing. We see the Ichimoku cloud flip after seeing pink vectors. The 50 EMA is lost. We see another buy zone coming up. We make our humps. And you can see that we crossed below right here. It's been very brief. So far, it's been longer. It's been roughly 4 bars at this point, so double the prior one that I went over, which again, like I said, things are decaying, so it makes sense that things are kind of lagging behind, but it's also very interesting that we are basically within the same time of the year. We're end of August heading into September. We're a little bit early as opposed to the one that I previously went over after the March crash, but for all intents and purposes, it's still essentially the same area. So I wouldn't be surprised if, you know, like I've been saying a lot recently, towards the end of September, maybe first half of October, we see this flip back up again. We've already met our local low right here, hitting at about 25.1 thousand, and then the bull market is going to begin. We will see something very similar to basically this area back here from September all the way up to right here in September of 2021. So September 2020 to September 2021, I think we'll see something very similar to that, taking us to $180,000 to $245,000 approximately. Possibility that it could push towards, you know, wicking to maybe 260 at highest, but I think 220 to 245,000 is definitely more likely for a higher range. And then obviously, like I said, 180 for the lower range. This is the first chart that I'm going to go over and describing my personal strategy. Down here, each of these vertical lines we've been seeing throughout this entire time line up with each of these blue dots you can see down here on this RSI, where it's printing bearish or hidden bearish or bullish or hidden bullish divergences. We can see that basically each of these points that I have designated and pointed out, all of them were bullish, except for you could argue that this one right here wasn't necessarily bullish. It still went down a little bit, but it basically predicted the bottom for you back in 2018. You could argue this one right here as well back in October 2014, but it's still essentially, it's within the buy zone of the strategy. You're already seeing your pink vectors. This is your best period of time to start buying as much as you can, and, you know, buying within this range, this period of time before things start to take off towards the upside. But outside of that, you can clearly see going all the way back, as far as I went back, 2012 bullish, bullish. I mean, let's pull this up. We can see it's roughly, and there's a specific emphasis on these, like for example, this one right here back in September 2013. This is a pivot point that happens after we see a bearish and hidden bullish divergence. It's not encompassed within the actual bounds of these divergences, but it's that one after that then goes towards the upside. Again, like just slowly going through all these, every single one of these are bullish except for those two, you know, slight exceptions I went over. If we go to where we are currently, You could also argue that these two aren't particularly bullish because it was just in a relief rally, but I mean, you bought down here, you basically had 120% profit. If you bought right here, nearly, 60% profit. But what we see right here, again, another similarity between going back to March and comparing it to our recent low. You can see back here we had a hidden bullish divergence. Didn't get the bearish divergence, but nonetheless, we had a hidden bullish divergence. This pivot point afterwards is what lines up with September. We see a hidden bullish divergence and a bearish divergence. Remember the continuation that I mentioned earlier. You can also see down here another form of that where we see a hidden bearish divergence, bullish divergence, a pivot point after the encompassing of those divergences. And that is what lined up with 15.4 thousand, leading into what is most likely, in my opinion, a bullish transition we've been seeing for the last like approximately 11 months. Outside of that, here is this chart right here. This is going to be going over some moving averages for the most part. Also have another RSI on here that I want to go over. I think there's a MACD as well, but these moving averages, 3 of them are smooth moving averages. The red, the green, and the purple are smooth moving averages. So 3 of those, and then the other 3 is the 5, 13, and 50 EMA of the Trader's Reality indicator. So if we go all the way back here, this is the monthly chart. So this is basically about as viable and strong you can get when it comes to putting on reliability and trust within any type of analysis done. Higher time frame charts are always going to be more trustworthy and more valid than lower time frames because it's taking longer for the patterns and for these indications to form. But what we see here is the pattern we're going to be noticing is that it doesn't really show it as much right here because Bitcoin wasn't as decayed, it wasn't as mature, so it wasn't kind of printing this, but we'll see the green and the yellow be the bullish indicators, basically where they cross up here after the bull market. They're the ones that are on top. They have to come down and then cross below the pink and the red. The black also will cross below the pink and the red. Like I said, you don't really see it too much right here, but the white ranges represent the beginning of the moving average zone that I'm pointing out, which this moving average zones that I'm about to go over for this chart are synonymous to the zones that I went over, these other ones on the 6-day chart. So if we just fast forward to the next area, these orange zones are just basically the zones that needed to be flipped, were obviously very important areas of flipping in order for the bull market to begin after we see this moving average confluence. Here we can see every single one of these moving averages, except for this bottommost black one, they all interact. We see the blue, the green, after the bull market's over, crosses below the red and the purple shortly after the black does, and we can see right here that like this kind of almost oval is created, and we see this black moving average right in the center of each of those. Once the black, the green, and the yellow move back above the red and the purple, the bull market ensues as it did previously. We can see that we bottomed out on the lowermost black moving average. Fast forward into 2018, 2019, you can see basically bottomed out with respect to it. We can see the same thing here. We see the yellow and the green cross below, purple and red going above, and the black is going in the middle. Leading into the March crash, we didn't even see anything cross over, which is very similar. Again, like I've already drawn conclusions between these two areas in the previous chart. It's very similar to what we're seeing right here. We can see again blue, green, blue is red, purple, black is in the center the entire time. And this time is the first time in history where the price went significantly below this bottommost black moving average. It was the first time the black moving average was actually within, the oval that I mentioned earlier, this range that's being created. But what is very similar here is that we've never seen this red moving average cross below right here as it did in August last month, the bottommost black moving average. I mean, perhaps it's going to end up being embarrassing. Perhaps it's going to end up basically being a bullish thing. It's going to cross below and quickly cross back above, similar to that Ichimoku cloud that I went over on the 6-day chart. And we'll, in further cycles, when we see the red cross below the black, it basically means we're shortly heading into the bull market. But I think the main thing here at this point to not see If we go all the way back to the March crash right here, you can see that once the yellow reclaimed the green, we didn't go back below the green, and the green didn't go back below the black. If we compare that to where we are currently, we can see the yellow has gone below the green, but the green, yellow, and the black are above the red and the purple. If we start to see the yellow go below the black, it could be a bad thing, like I said, or it could be something similar to this red moving average and the black moving average, where it just happens for a short period of time, and will basically in further cycles, like I said, act as a indicator that we are like literally right at the precipice of having a major bull market in terms of seeing massive parabolic gains. When it comes to this RSI down here, I find this is perhaps the best RSI indicator I've come across. This one right here is just RSI. If you just look up RSI, then it'll say Tories right here. But we can see each of these highs from being overbought. We're basically in a horizontal range for the most part. We can see these, which I added these yellow dots. They're actually green, but I added these yellow dots to kind of differentiate how I can see there's a rough, pretty clear area where the RSI is going within a range towards the downside in a descending manner, becoming more oversold each and every single cycle, which is why it's becoming weaker, it's decaying, etc. Why things are cycles, phases, bull markets, bear markets are taking longer and they're less bearish or less bullish. But then we also see these other, like for example, if we go to this red dot right here that was printed at the RSI, it predicted down to the month, the high of April 2013. If we go to right here, December 2017, it did the same thing for 20,000. We go right here, it did the same thing for 64,000 in April 2021. And then like there's a red one right here that kind of predicts this local high as we go sideways back in 2016. There's another red one right here that predicts this higher local high as we're about to break out. We saw a minor retracement, then we continue to go towards the upside. I mean, even this green one back here in April 2014 marked this local low and went down to $346. Then 2 months later, it went up to nearly $700. And then if we take a look at these blue bubbles on here, each of these are basically, all of them are lined up with when the price is breaking out of the white range, breaking above the orange range. You can see each and every single time, roughly lining up with it. Not as much with this phase back here from 2018 to roughly like May or so of 2020. For the most part, these are all basically, this is a confluence basically that I'm pointing out. I basically find the exact same pattern in all of these indicators. They're also happening within the same time period. Each of these bubbles are from, we can see March, April to March, April, right here, March, April to March, April, March, April to March, April, so on and so forth. And then the center is September, October, each and every single time. September, October, September, October, September, October. After we've seen the yellow dot, we've seen the moving averages that I went over. I mean, going back to this chart, what I went over, we have a pi cycle high-low indicator here. We can see that the highs were predicted very nicely on here. And the reason why we're not seeing, actually, I think it's been on here in the past. I think I may have tweaked with the inputs or something, but in the past, you can tweak it to have one right here. But anyways, I mean, again, like I was saying, this is pointing out the confluence. I mean, we're basically seeing the same thing being represented on all of these indicators, leaning more towards the bullish side. But again, like I said, main part of this analysis is to understand that despite all the data for all things, I mean, anything could happen. I mean, for all you know, the war could break out tomorrow or something other than that catastrophically could happen and completely just collapse the entire asset market, whatever it may be. So here, the final thing I'm going to go over, I'm going to include DXY in this. Basically, we see this descending channel here. I've already gone over this. I think the dollar is basically just going to die over the next, decade, roughly. But we can see each of these pivot points up here being the bearish drawdowns. Fundamentally, this is a massive macro W pattern that I think we have seen playing out, and we are at the end of this W pattern, which will be bearish, so we got to go down. We got to kind of return back to the median, not the median, but the return to basis at the bottom of this channel roughly, and on top of that, with these 2 yellow and 2 purple dots, and then these kind of basically these rounding out bottoms right here. Look, that's pretty clearly, again, we're basically just seeing this massive W appear over time. There's also another main factor of my analysis as well. This is how I view price harmonics. As I went over the Elliott's, the other harmonic pattern, like the Gartley's, and just general inverse head and shoulders and things like that patterns. I use those. They're obviously very important, I believe, but the main way I think it is best to actually understand the way that price actually fluctuates is to look at it in terms of alternating M's and W's. For example, this first W right over here is a type 1 W. It is a type 1 W because if you see right here, you see we have this bottom range right here of the pattern, this horizontal, and just to kind of, I mean, it could be something like this as well. We could see a bottom portion that's kind of more so descending and broadening rather than the horizontal. I mean, obviously, clearly this is factoring in what I went over earlier, like having horizontal channels or falling wedges. If you look at the way that price forms within all of the patterns, if you look at and alternating M's and W's, I think it's just the easiest. But anyway, so that's a type 1 W. We have a type 2 W right here because, again, within this consolidation range, we have 2 peaks. Right here's a type 3 because we see 1, 2, 3 peaks. Type 4, we see 4 peaks, and then type 5 peaks, so on and so forth. Right here, this could be another type of type 4 W peak. This looks similar to a, like I mentioned, some sort of broadening wedge, a bullish megaphone. This one could typically be considered bearish because it's coming into the pattern from the downside. Typically, that is going to put some sort of disproportionality to the fact that it's going to break down like a bear flag, where you'll see price as it's coming down from a high, come down here and consolidate like this. Eventually it gets rejected and it comes down. Finally, let's say makes a type of double bottom right here, and then finally actually goes back up towards the upside. You could say that this type of view that I have here is similar to the Wyckoff logic, and that it's kind of denoting, the way, fundamentally, the way that the price is alternating between W's and M's, double tops and double bottoms, with the various types of, like I said, type 1, type 2, W's or M's patterns, kind of making it more complex, noting it like accumulation zones and lows and highs. Here on the left again, we can see right here, this black pattern, this line pattern that I have in this W, this is what Bitcoin looked like from 20,000 to 64,000 when we hit around, I think it was like 3,200, and then we hit around 3,000 roughly or so back in March of 2020. This would be a type 1 W. You can also look at it as a type 2 W, kind of making it the W a little bit more complex right here. Right here, this is what Bitcoin did from 64,000 all the way to 69,000. We can see a type 3 W here, came down, we had 3 peaks. It's basically a W with an M that has a W as its consolidation range. So basically what we saw there is we see in this consolidation range, we see an M with a W that makes up its first top and its second top, leading to the double bottom. And again, so W's are going to be bearish because you're going to want to sell the highs, and M's are going to be bullish because you're going to want to sell the lows. Lastly, we can see right here, this is what Bitcoin looked like from actually, I forget what the time period was. 2014, 2015. It was from right here in June 2014 all the way to June of 2016. And we can see we made a type 2 W right here coming down, making this M in the consolidation range, leading to the final bottom of the double bottom, then led into the beginning of the bull market. But quickly to go back here to the DXY, this blue range that you see on here, this is correlative to the golden pocket range of their tracement from the top to the bottom, high side of the highest low. So I think if we lose 95 to 98, then things are likely just going to slowly collapse after that, especially if it then starts to lose 90. We'll just say definitely 90 to 80. Like I said, I think it's likely to do that towards the end of this decade, maybe pushing like 2032, 2034 at the latest. I mean, even these patterns down here are also, I can point out the types of double bottoms, like we come down right here and we make this right here, type 3W, and then we go up, come down right here, we can do this. I look at this more as like an ABC towards the downside. Then we make one M right here, another M right here, and then we finally go up towards the upside, where I would personally look at this as a type 4W with these 4 peaks right here, with this initial lightning bolt downside being broken down into an ABC or ABCD type pattern. And then the RSI on here is essentially the same. Not really too much for me to go over when it comes to that. The thing that I didn't touch on was the MACD. This is a MACD pair with Bollinger Bands. You can see that we flipped white, but we're still waiting to flip the convergence zone. I think it's, I found it pretty important to put a line at the 0 point for a MACD. Typically traditional MACDs will come with it already, but this one didn't. Once we finally see, we're flipping into white, basically lining up with a bullish, out of a bear market into a bullish transition. Once we flip blue and then actually break above the 0 point convergence, then that will really be, in terms of the momentum of price, the final thing to really load into an actual full-on bull market. But all right, so at this point my trading strategy breakdown's over, but because I included this DXY analysis, I want to quickly go over this before I wrap things up. So these projections that we're seeing down here, not only obviously is it coming down and roughly meeting the bottom of this channel, but I took, each of these are 4 different price targets I took. Basically what I did was, I suppose this could still be a part of my trading scheme as well, but what I did was, is given that this is basically kind of like looking like a massive bowl, what I did was, is I took from this low of the W towards, I find where the center point here on this line is, and I draw it to it, and I would do the same thing down to this low right here, and then I would drag these two over, move them around a little bit so I could create this like projection pattern right here. But I did that 4 different ways, and then that gave me this range right here from 60, 67 down to 54. And then on top of that, what I did was is I took the percentage drawdown of each of these drops in this macro W pattern. It's 37-year, the 37-year long macro W pattern also. This was a 52% drawdown. This one right here was a 42% drawdown. And then that also just happened to line up with what I had already put on here. As you can see, this is a 42% drawdown. If I go all the way down to the bottom, it is a 52% drawdown. So I found that that was a striking confluence that I definitely didn't intend. So I thought that was pretty interesting nonetheless. But like I was saying, that was, again, all that I wanted to go over in this video. So hopefully you enjoyed, hopefully you were able to learn something from this. Any of the actual technical analysis I went over in this video is not meant to be financial advice. This was supposed to be and is an educational video. So like I said, hopefully you learned something from this, and hopefully you're able to further yourself within your trading and develop a strategy. Obviously, don't just copy mine. What I really want anybody to do is to kind of, learn from others, obviously learn from other sources, but also take all this information that you're using and try to make something even more innovative or come up with a strategy that works well that nobody else is doing. But all that being said, everything gone over, I hope you all have a blessed day.